so I don't forget. Okay, so okay, hi there Nazim, hi Colin, hi guys, Sashi, everybody, it's good to see you guys. We have got quite an interesting part 3 goals tomorrow, a couple of things to share with you guys, couple of slides, facts, and a couple of questionable events, and perhaps to get your opinion as well on that. So it's precious metal, but more a higher focus on gold. Okay, so this is quite an interesting one. Before we go into the technicalities, meaning more into the geometric patterns, combining it in part 4. In part 4, we'll be doing that much more. Okay, so we've got another minute or so to go. And for you guys there, just before we start, who's been trading gold? Anyone? You guys out of the crowd now have got any interest in gold, or you guys are still researching or actively trading? Perhaps some of the traders I've bumped into in the past are trading physical gold as well as on the trading FX trading platform. So what about you guys? You guys are good? Occasionally, Nazim, that's good. That's good to hear. There's a lot of facts and figures, as well as a couple of tips, trade ideas for you guys as well today, but it's from various angles, okay? Fundamentals, geopolitics. We mix and match that up, and then we tear it all apart and see what is relevant, what are relevant areas to consider, matching it with the geometric patterns as well in part 4. So today we're looking into medium to long term, and what are the backup in terms of geopolitics, politics, data as well. And we'll talk about all these things today. So it'll be quite an interesting one. Thursday Fed, yes, the dollar seems to be pulling back as the market not expecting a rise. That's the figure that I call in 0.25. But that's the thing I want to talk a lot about as well. It's about the effect of something or an event that has been priced in, so everybody is thinking the same, meaning talking about the same thing with the same sort of numbers, data about a specific type event. Okay, in this case, it's the interest rate decisions. So in this time around, that is where the risk lies, because any slight tweak or change to the general expectation or majority expectations will just tumble the whole thing and create the opposite directions, the route to the opposite directions even further. So the downside would be quite, I would say, crazy. Okay, so yeah, we'll talk a bit about that. I just want to share with you guys as well on patterns, geopolitical patterns, events that have actually occurred in certain time of the year, many years ago, and whether or not we were looking at the same pattern. Okay, we want to look into our new into the new president as well, state of monetary, fiscal. How is he, having plans? What sort of plans has he got for the states, and how would it impact the dollar, and how that that status of dollar would then impact gold, precious metals, and things like that. Okay, we want to look into the overall picture. Okay, so let's then start. Okay, if you guys don't mind, let's just start. Okay, first and foremost, a big thank you for you guys attending today's part 3 of the precious metals certification course. Today is the 12th of December, 2016. Okay, and welcome to part 3. And what we'll be talking about today is simple. I'm just going to give you a bit of an idea or trade idea, but it revolves around geopolitical factors, things that I will be sharing with you more on the medium to long term, so that you get an idea of the overall picture of what's going on in economy, geopolitics, and all that would then impact prices or movements of precious metals, including gold. Okay, just before that, let's just carry on. Let me just preset screen there. Okay, there you go. It's titled Goals Tomorrow. Okay, so what are we expecting, in the long run? What's the route that we are actually living through at this moment of time? okay, with regards to politics, geopolitics, and all that. So before that, just a bit of a risk disclaimer, as usual. Any opinions, news, research, analysis, prizes, or any other information contained on this presentation, today's webinar, and uttered in this webinar by myself are all seen and regarded as general market commentary. Okay, so myself as the presenter, as well as Orbex Limited, will not accept liability for any loss or damage, including without limitation to any loss of profit which may arise directly or indirectly from use of or reliance on information I have shared with you today. Okay, or is sharing with you today. So with regards to the foreign exchange market, of course, it's trading on margin, which carries a high level of risk and may not be suitable for all investors. Okay, this is quite standard. The high degree of leverage can work against you as well as for you. So before deciding to trade foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. All right, guys, so let's get going. So first and foremost, I would like to introduce you to market cycles. Okay, I just want to talk a little bit about it. It's not theory anymore. I just want to point out on where we are in terms of the market cycle that we're in. Okay, you guys know in terms of technicalities itself, price moves in trends, trends moves in cycles. Sorry, trend moves in waves, waves moves in cycles. Okay, so here you go. I mean, based on theory itself, I'll just then you've got that little box below. Give you a bit of an idea what the big boys are doing. Okay, but of course the Dow theory itself describes three types of trends. So you've got the accumulation phase or accumulation cycle. Okay, that's usually the sideways trend. Okay, and it's more of a sideways trend that's a bit narrowed down. So you've got accumulation phase. The market has just turned up. For example, well-informed investors are starting to do they're starting to long their positions. Okay, public participation phase is the media begin to report on the rise in prices. Many investors decide to enter the market. So you see, these are sort of revolutionized or evolving type phases as well in the modern times. We've got a public participation phase here, and as you know, mainstream media has got a lot to do with that nowadays more than ever before. And you've got the distribution phase. Now the distribution phase, when you zoom out onto your chart, you see the highest point to be really volatile, the peak area, but then it's got a sort of a volatile sideways market. Okay, and that's usually the distribution phase. The interest of the broader public increases greatly. The market is near peak, but smart investors are already beginning to sell. Okay, so that's basically what it means. What I usually do is, just to give you a bit of an idea, is you've got that bell shape there, right, like that, yeah. But you've got accumulation like that, and then up, and that's your highest, the peak area with the distribution phase, and then market goes down, and then you start accumulate again. So that smallest sideway there, that's your accumulation phase, and that's your distribution phase. Then you've got a downward market here. Okay, and then again it goes sideways. All right, so that's more or less how it looks, like an upside down cup. Okay, your cycle looks like this actually. Okay, there you go. That's all right. So this is what's going on, and this is based on the Dow theory. So we want to look into where we are at the moment. Okay, and here you see in the red box below, you see that I've just put that cut and paste that we see reports that highly successful macro investors. You see, this is something I want to share with you, is the macro factors, macro investors. They see the big picture of things around them, on the perspective of environmental, like geopolitics and politics itself, economy, and everything else. Okay, so you've got names here. Maybe the one that points out easy is the Paul Singer and George Soros. Of course, it was Stanley Druckenmiller. And they all have amassed large gold-related positions, as it says here. I've taken that out from Bloomberg Research. Okay, so a position as an indication that the accumulation phase is already behind us. So They've been interviewed, these big names have been interviewed some time ago. I've got the cuttings of all these research, from my research, I've got all these cuttings of interviews and what they've actually said. And, interestingly, they've actually said that the accumulation phase is behind us. Okay, so that the market is now in the transition period to the second phase. Okay, what's the second phase? It's the upward side move, and also on the other side here it's a downward side. So you've got accumulation in both sides, right? So it could be for one instrument on that leg, it could be and another instrument on that leg there. Okay, so it depends on the it's cycle sensitive, instrument sensitive. So that's basically it. Okay, so let's look into the next slide. So yeah, okay, there we go. So let me see whether I'm doing it right. Okay, that's correct. So this one here is really interesting. Okay, I'll give you a bit of an explanation on this chart illustration that you're looking at the moment. Cycles in the commodity markets, talking about commodity. Now, this is since 1970 right up to now, 2016. Look into each one sort of area here from phase 1 to phase 4, that's one cycle. Okay, you've got that upward sort of movement. Okay, and this is 2016 here, the last box. So you've got 3 boxes here. Each box are made of 4 phases. Okay, now we're talking about 2016, and that's the end of the this 3rd box here and the end of the 4th phase. Okay, so you can see that the movement is sort of quite standard here. Let me just see whether I could change the color. There, give me a second. Okay, so as you can see, you've got up, okay, down, okay, 1, 2, 3, and then 4, and 1, 2, and then 3, and then 4. So it all looks like an M-like pattern. Okay, so some may be looking into harmonic pattern, godly type pattern, and all that. But then let's forget all that for now, and let's just look into it as a cycle. So that this whole box here, that's one cycle. But then that again is, oh, sorry, mirrored again. More or less the same type of pattern. Okay, so what we're expecting is another upward move 2017 onwards, and that should make another move like that, you see. Okay, so this is, let's see whether that happens or not, but this is what's been expected in terms of cycles for commodity side of it. This is this being sourced from Bloomberg, and I find many other researchers, research that I've done, many other findings would actually mirror this one here in different forms, whether it's for the USD index. You've got of course total opposite of what we see here in the commodities, but they sort of have got that pattern. And the funny thing as well is you've got the correction phase in percentages, you know how much it has depreciated, appreciated. It's got a sort of standard type amount there, or with some here on the lower end in red circles, but the one on green, it only looks like it appreciates and appreciates. What that means is that we see that you've got the first phase of every cycle, or on average would be the biggest one, biggest move. So if at all we're expecting another commodity run to the upside, then that phase 1 would be quite significant, and that's the best leg to take, basically. Okay, so that's the thing that I would like to share with you, and let's just erase all the drawings here. I think I've got some questions coming up. Brilliant. Now let's see. Second. Okay. Is 2 phases one? Oh, Nazim, is 2 phases on cycle or 4 phases? Okay, that's a good question. Each cycle, each one cycle is that M pattern. It's every M is one cycle. Okay, so each one cycle made up of 4 phases, 4 legs. We'll put it like that, 4 legs. Okay, it's like the M pattern actually. If you look at it, you could see that the correction there. You see that correction here. It's quite interesting. That correction here could be as easy as an ABCD type pattern there. Okay, So we've got there as well, right? And then here, okay? So you've got ABCD, 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 but then that longer end of the first leg of the phase one attaches and makes it an M-like pattern. So an M-like pattern usually is a bullish type pattern where it ends at about D here and it starts to appreciate again upwards. Okay, so that's basically what happened here. You see, goes up after it ends at around here. Usually an M-like pattern, you've got your X here, okay, A right there, then B right here, C, and then B. We'll cover this one a bit more on the technical side. I'll teach you how to do the geometric patterns, share with you strategies on how to trade geometrically, and we match it with what we've learned today, which is on the geopolitical, what do you call that, the fundamental side of things, with what's going on and how do we look at it in the future. Okay, let's carry on. Alright, hope that's clear for you, Nazim. Yeah, that's four legs, 4 faces, 1 cycle. Okay, but that's overall, it's an upward channel, an angle that is like a 2 o'clock type angle if you're looking at the using the metaphor of a hand of a watch, okay, or a clock. Then you're looking at it, you know, giving hints to the upside. All right. Okay, brilliant. Let's carry on to the next slide. Okay. Right. Okay. Let's look at this one here, another very interesting one. It's not too much on cycles, but more on the correlation side of things, okay? But let's look into the comparison between gold and the US dollar below. This is US dollar below, the one in orange, that's gold, okay? So as you can see, let's look into gold and then the first green circle on the left, and then we talk about the second greenish shade on the right. Okay, the one on the left, as you can see, it's labeled saying gold fell prior to rate hike, then surge. So this is where I've seen a Z-like pattern here, which has actually have failed. So it's giving me more hints that because it has failed that pattern, more chances for gold to fall. Whether it's a bit more or a lot more, we're not entirely sure, but with time frames, we're able to do that in stages. That's what I want to point out in part 4. So look at this one here. We're talking about the behavior of gold before a rate hike. Okay, so now as you guys know, it's been a lot of them, colleagues that have actually asked as well about rate hike 0.25, that number there, and prior to it, whether it's going to have a rate hike or not, but then everything's been priced in, meaning a lot of expectations, a lot of talk, mainstream media, they're all talking about the possibility and the probability have actually increased. Whether it's accurate or not that the probability have actually increased, that it will be a rate hike, that we will never know, okay? But just playing with that mass psychology sentiment itself, that's where we have seen that fall there. Of course, gold is correlated negatively to the US dollar, so the first shade of green for US dollar will be total opposite in terms of movement for gold, right? So here, as you can see, again, we have got that pattern or cycle repeating, meaning gold falling prior to second rate hike. So, we are, whether we expect that rate hike or not, it's secondary. But the behavior is mirrored, has been, it's mirroring what has actually happened there. Sentiments talking about a possible, probable rate hike, and then we've got market falling, and this is what's going on here, and that's what we're looking into the US dollar prior to second rate hike here as well. So this is what's happening, okay? But again, that fall usually follows through a nice run upwards, okay? So this is what we want to do. We want to collect evidence. We want to collect more data in giving us a bit of a idea of whether or not gold has got whether gold's probability to rise is getting higher or lower. This is very important for us, so that we get the market sentiment and the trend very importantly. and only then we're able to go onto the charts, whether it's geometric trading patterns or any technicalities that you use or indicators or techniques, then you want to match that up with what you already know. So look at this here compared to the other ones. It's all giving us hints of a probability for gold's rise and a probability for dollar's fall. Okay, so this is basically it. Okay, any questions here on this chart? We'll go along, and as we go along, smooth and faster, you've got more time for questions as well, and we can always talk about it. Okay, so let me just move on to the next one. Now, let's see whether I've got the right one. Okay, a lot of talk about a repeat of 2015. Okay, there's some slight variations, they say, but it looks like there's a repeat in certain area. Okay, look at 2015, and you could see that 3-month Treasury rates have spiked a month prior to the Fed meeting, which is exactly the same of what had actually happened. Gold in 2015 fallen prior to the meeting again. Okay, the dollar risen in the preceding 3 months, which was exactly the case now. Stock market remained firm prior to the rate hike, exactly what's happening now. So question is whether or not it's a repeat, a mirror, an exact sort of trend or cycle. That's the question. But here we want to gather up these evidence so we are aware of the bigger picture of the market. Okay, that's the most important thing. Yes, gold has already fallen so much. Grace, you've got a good question there. If there is a rate hike, it fall again, and if yes, how low will it go? Okay, now I want to point out this, Grace. You need to be very careful here. A lot of experts, and through my personal research itself, is saying that even though there is a rate hike, there's a possibility for gold's rise, so be careful. Okay, I'll explain. In my preceding presentations, we've got a couple of things that may give you a better idea why this thing is happening. Okay, so any correlations that you are dependent on now as a trader may all be changing because we are exactly in that 35 to 40 year cycle where monetary policy bound to change, and the whole international monetary system changes as well. So a lot of things may actually change. Okay, so I don't want you to put that solid idea in your mind that if it rises or it will rise and then you see gold just tumbling even more. No, we need to now start to understand that the market may be operating on a complexity theory mode, meaning very simple, expect the unexpected. Don't follow the norm. Okay, we've got to be very, very careful. Okay, so I'll take you through, don't worry, and then we go on to the next slides, which would give you a better idea. Okay, so here, for example, the last paragraph below, in summary, these four markets are showing similar interrelated action, okay, or a correlation, basically, a positive correlation. They mirror each other prior to the upcoming December 14th, okay, which is tomorrow. As they did, that's tomorrow, 1 year ago, prior to the last interest rate hike. Okay, let's see. All right, so we need to understand, as I've mentioned, the core engine. Okay, because we're going past Brexit, correct, and then now we've got Trump as well, and we need to understand that the whole mechanics of the markets are changing. So you've got new factors that may actually change everything. Okay, so we may not be, how do you call that, it may not be a good idea to be reliant on what we have seen as correlating anymore. Okay, we need to now find a new strategy of understanding the fundamentals. Okay, so this is understand the core engine that could drive the path to goals tomorrow. So what are they? Here they are. This is something that you could just have a look on Google, go into it a little bit more, but I'll just go through it now. The key word is inflation. Okay, the trend in inflation and inflation expectations. So something you can type it out on Google and click on the news tab so that you get all the current news that is correlated to that keyword that you're looking at. So at least it's recent. We're not wanting to go and read about theory anymore. Okay, so the level and trend of real interest rates very important. The trend of the US dollar and other fiat currencies. So fiat currencies are what we are on now. Okay, so the dollar itself, as I've mentioned in the first part itself, has got it has been devalued by almost 97+%, so very close to toilet paper type value. So there's a big problem with the fiat currency now, especially with US dollar, because it was a very smart system from the very beginning, from Bretton Woods time, and then the gold has been taken off. So the US have actually made many countries dependent on the dollar. Okay, so now the US dollar, for example, is traveling all over the world, and a lot of reserves are having the US dollar, but then they're having the US dollar and they're actually suffering having that US dollar that has got not much value left in the paper money that they are holding. So what's causing them, what the problem that they're causing with the US dollar they've got is to put these countries, now let's say the countries that have got lots of US dollar and they have bought lots of US dollar before, looking at the dollar being really strong at one point, and then they keep all the dollar, and then dollar fell, for example, and all that. These countries will be put into debt. So I would like to talk about which countries are really at risk, and you need to know about it, whether it's South Africa, whether it's another country, Turkey, or wherever. I'll present you another slide for you to get an idea of how strengthening dollar have actually put these countries into risk. Okay, so that's one thing you need to understand. You need to know about credit spreads. I want you to just read up. Don't worry, I wouldn't put all these ones that have got no much explanation on it. These are all extra information, but they are all highlighted points that are factors to consider that are actually shaping this new sort of expected monetary policy and the way the economy would actually follow through. Okay, the trend and momentum of money supply growth, very important. Opportunity cost, confidence in central bank policy. Okay, the stability of the financial system, economic developments, the demand for money and propensity to save, all this kind of thing. But don't need to worry a lot about it, in there, because I've got the slides to give you a bit of an idea of what exactly is going on at this moment of time. Okay, so look at what Stanley Fischer have actually quoted here. We may well at present be seeing the first stirrings of an increase in the inflation rate. This is recent, by the way. This was just about last week or a couple of days ago. I was on Bloomberg, if I'm not mistaken. And see the thing in the box. Price inflation dynamics are, in our opinion, the element that can tip the scales toward a sustained upturn in gold prices. Okay, in gold price. This was mirrored by reports in banks and other huge experts and big figures talking about it in Market Watch, in the insiders, and they all have actually come to an agreement that they are also expecting an upturn in gold prices, and they've confirmed that we are in the phase of inflation. Okay, and the phase where the past accumulation of going upwards or downwards phase, that leg, okay, an up leg or a down leg kind of thing. So we're in momentum sort of potential to enter the momentum phase. Okay, all right, here we go. Various U.S. inflation indexes. Okay, just give you a bit of an idea. It's a Federal Reserve as the source here. You can see at the end here, 2016 April. Look at CPI, okay, price index, very much it's got a lot to do with inflation as well. Look at how all these jumbles up, sticky price index and all this. I don't need to go into it too deep, but giving you a bit of an idea. I just want to follow through the slide so that it gives you an idea that all these ones are latest figures, latest charts, just signaling inflation. As you can see, global inflation outlook of rises, as it says. I think this was just about a couple of days ago, if I'm not mistaken. as well. They're all, no, this is not the date here. 8th of December, yeah, 2016. So as you can see, look at that angle of that chart, line chart moving upwards as well. So what I'm trying to say is that you've got more and more hints. The momentum of news and media is picking up tremendously, hinting inflation, and everybody is talking about inflation at this moment of time. Okay, so what does that then bring us to? So we've got some other news that signals inflation, but coming from a different perspective. Here you've got China factory prices, okay, jump 3.3%, lifting global inflation outlook. Again, this one's Bloomberg. Then you've got that on the 9th of December. Then you've got PPI, okay, purchasing price index increase exceeds all estimates in survey. So CPI, again, climbs 2.3%. So all I just want to tell you is that you've got inflation going on big time, okay? The momentum, the power of it as well is boiling up a good soup of chaos, looks like it, okay, with the inflation number. So producer prices in the mining industry, again, increased 14.8%. Yeah, so here I want to give you a bit of a hint on what's going on now with Trump. Has got a lot of expectation of how it could then impact world economy as well as a change in international monetary policy. Okay, let's call it Trumponomics. You've got it on mainstream media as well talking about it. Now, I want to just point out, if you guys ever fancy reading a little bit about Ronald Reagan's time, okay, he has cut taxes, increased spending, and all that kind of thing, increased deficits. And the thing about Trump is that the team that he has gathered to be his right man, left hand, and everybody under his team to run the country, who he has selected as well, are all under that Reagan type model. Okay, so here the thing I want to tell you is that I don't know whether you guys have heard about helicopter money. Now, Trump is the best candidate for being a helicopter money, what do you call that, type president, okay, meaning that the combination of fiscal policy and monetary policy, a lot of spending, you know, a lot of government spending and spend, and you've got to pay for that and all that, just to get all the sentiments from the public building up. So it looks like he's, you know, making things happen, you know, very business minded and everything else. But then the thing is that he's increasing deficit at the very same time, okay? Of course, he's cutting taxes. Now, all that has got a lot to do with how Reagan has actually run. The difference would be the interest rate, what do you call that position? The interest rate Reagan time is about 20%, so the only way it could actually be going would be going downwards, okay? But then with Trump, we've got the States 0.5%, let's say, interest rate, right? So there's a lot of room to go up more, you see. So this is where the difference is. So we are looking into, that's why I'm talking about the interest rate, what do you call that, or hike possibility to raise, hike, and all that kind of thing. So this is mainly it, because you've got loads of room in Trumponomics, you know. Trump time, when he's into it right now in the world, it's all interest rates they're all low, okay. You've got certain countries have already reached that negative zone, NIRP, okay, negative interest rate policy. So this is basically it. So again, I think I've repeated this one, heaven for whom. So all these things that he's doing would then be very much investor type, pulling in all the investors. Okay, so this is how he works. That's the reason why he anti-Yellen's, because he's more into pulling investors in, and whatever he's doing now is just giving it a better possibility, a heightened possibility for inflation to happen. So he's very inflation prone type president. Okay, so question. Nazim, austerity measures have proven detrimental to an economy, Nazim says, so isn't spending that Trump intends to do a good thing? A very good question, very deep actually, and I like your question a lot, Nazim. You've got a point there, but here we're talking about Trump, who has got his own agenda in running things, and he's got his own mind, okay, on how things are supposed to do. So as you can see, maybe you already noticed this, everybody's got their group of people, birds of the same feathers flock together. Okay, so you've got Yellen, Bernanke from before, and everybody else, Clinton and all that, they all flock together and they all come under this thing that we call, it's not a complexity model anymore, okay? So it's a model like an airplane where they think they want to go higher and then adjust something, so they think that that will go higher. So that kind of model doesn't really work anymore. But Trump is not really doing everything that could actually be higher probability of success kind of thing, because he is he's sort of how do you call that, in various areas like geopolitics, with the relations with China and all that. He's got his areas of focus, and he's cutting down and big time saying a lot of things about China and everything else. So he's causing, what he's causing now is a bit of a dominoes effect with what he is, how he's reacting to China, how he's reacting to the other parts of the world. What is happening is that they start to form coalitions among themselves. So that's why you've got Turkey with Russia trying to create a currency war whereby they want to trade amongst themselves with their own currencies, just them, and then you've got two other countries pairing up. So this is what Trump is actually causing on the outside, you see. So that may not necessarily be entirely good, because you then have got all these wars happening, which is not the physical type of war that we see blood pouring anymore. We've got trade wars, we've got currency wars, cyber finance war, and all that kind of thing. So that is what has been seen as a threat that could actually happen as soon as now, you see. So this is where we classify that as increasing the global risk now. So he's actually into red alert at the moment in causing global sort of risk. Okay, Nazim? So it may be in a different context be good, but what he's doing has got various layers that is actually happening like a dominoes effect at the moment. That's not really going to show good results in the long term. Okay. All right, so the lines below, gold prices most likely will appreciate, as it says. Trump's policies are inward, okay, is what I wanted to say, inward looking. So that's why you've got that ripple effect on the outside. It's not good, because he's so much inside, inward looking, and which basically weakens the fundamentals of the US economy. So when it weakens, then you've got a reliant on the dollar, you've got emerging markets and all that, all the ripple effects start impacting the outer layer. So you would need to put US and Trump in the middle of the ripple, and all these ripples are the global economy and other countries that may be reliant on what goes on in the States and what Trump does. Okay, so he's well and good known for tearing up trade agreements. So this is what we could see. He's against the France agreement. He's against that. He's against this. So he's a threat with the TTP. He's a threat with a lot of agreements when we're talking about trade type agreements. Okay, so this is where a rise in overall uncertainty. So here uncertainty is dangerous. Okay, over the policy outlook. So this is where we find lots of global risks happening at this moment. Right? Okay, now. These are Trump's team. Want you guys, if you have a bit of time, look into what their views are. So what their views are, Trump's team itself would then build up that Trump formula of running the country and monetary policy and fiscal and everything else. And that ripple effect is what I'm talking about, that would then build up new trends, whether it is for precious metals, stocks, whatever that is. That's just a little tiny piece of the whole thing, because it will ripple effect into various other things, other areas. Okay, even global warming and everything else, because he's got his own theory with global warming as well. So okay, here you've got This is after Trump's victory, okay? And here we've got just giving you a bit of an idea. As you've seen, it has actually broken up a channel here. It's reaching upwards at the moment. We're talking about gold here. So it needs, it's got this area for it to break out. All these lines that you see, blue and purple, and all that are all various trend lines from different angles, okay? Just give you an idea. Here you see the last paragraph below here, note the multiple hits last summer on that same long downtrend. Okay, we're talking about the downtrend, this whole big move here, downtrend, followed by the price retreat to 1245 in October. Okay, so last paragraph quite important. The same trend line was tested again this morning. I think this one here was meant to be a couple of days ago, if I'm not mistaken. I think it was the 8th of December or November, probably last month. That was then, just to give you a bit of an idea of price history here. But then let's just look into the next one here. This is the most recent one here. We've got something revolving or regarding risk. I think we've got questions here. Sorry about that, guys. Let's just see. Yes, Muhammad Asim, what is Trump trying to do with China at this moment? Okay, that's a very good one. And with respect to the trade agreement, okay, this is quite complex. I'll try to put it as simple as possible. Now, the thing is that Trump sees China in a very different view, okay, because he sees it more a threat, and he's physically going against that threat, okay. But before Trump, the states know that China is a threat in various areas, okay, not only trade agreement and all that. But to cut the long story short, with regards to trade, it has got to do with this island, wanting the islands and all these very deep root geopolitics going on with China. So Trump sees that there is a bit of a big threat if U.S. goes into encouraging very good relations with trade, then it may then support China, but U.S. very quietly supports Taiwan much more than China as well. So this is where there is a bit of a big conflict of interest there that Trump doesn't actually want to go into. Okay, so it's not directly has got to do with trade agreements, because it's got a lot of deepened factor. For example, China wants all these islands close to Taiwan, close to the other parts of the Southeast Asia regions, mainly because of gas. You've got thousands and thousands of cubic meters of gas, because China wants to change its whole economic model from coal-oriented to gas-oriented. So it is not one island just because it likes the beauty of the island and it's actually into the natural reserves or the greens and the birds and all that. No, it's just it wants certain things for its transition from what it was in a model of economy into another model. So that transition of model would then give Trump and his team, or the whole of the states, competition. At the end of the day, it's competition. It's big competition. Okay, so hence the reason he's not actually attacking just agreements. He's actually attacking the whole model play of China. Okay, because China, it's not also easy to just do everything against China, because China is also absorbing U.S. Treasury debts as well. U.S. debt is absorbed by China buying U.S. Treasuries too. So this is another problem. And then China is actually using the gold reserves that it has accumulated to hedge these U.S. Treasuries as well. And the same goes for U.S. U.S. is also doing that. So U.S. has closed an eye to, in the past presidency, they have closed an eye for China manipulating prices of gold and its yuan and all that as well, because they are working together from inside. But I think Trump is looking into more threat for the future that will build up if he doesn't actually intervene in saying it directly that he doesn't like China and this and that, you know, all kind of things. But it's more than just a trade agreement. He just wants to not have that whole working of it, because it threatens his position and his plans for the future. As simple as that. Okay, so slides aren't opening up completely. Okay, let's just check that. Can you see the slide now or not? I'll have all my slides on slide share as well once we complete all the 4 parts. We'll have it available on slide share, so everybody could have it free. Okay. All right. Thanks for that, Colin. Maybe it's at your end. The screen may have minimized or something like that. Okay. Parts blocked. All right. Not sure actually, Nazim. Maybe you want to. I don't know. Let's see whether the next slide. Let's see. It could be your internet as well. You know. I'm not sure because the streaming of it maybe. I'm not sure. Okay. Let's see. All right, here you go. Now I want to show you guys, share with you guys some of UBS's, I shouldn't say that like that, but UBS, okay, the bank's macro trades for 2017. They've got 4 themes. They are giving these reports to their main big investors, giving them tips, trade ideas, but they want their investors to focus on 4 themes, 4 areas. So these 4 areas could then help you as well, you guys as well, to spot trade ideas and what sort of instruments to focus on and things like that. Okay, so theme one, it's best to actually look into growth acceleration. Said by UBS, okay, and I agree with this part of it because I see that I've underlined bullish copper, palladium, and gold. So in terms of precious metal with UBS, not only UBS, you've also got Barclays, let me think, ABN AMRO, and a couple of other banks. They have all mirrored sort of these kind of what you call it, trade ideas, you know, and that's very interesting for me because when you see these big boys or big banks, the first few that have got loads of or highest FX transaction, and they are giving their selected investor or people in their VIP group simple trade ideas like this, then it means a lot when different banks are also focused on that same type instruments. Okay, so CLP, I may actually be a bit confused with that CLP itself. Where is this CLP that you see? Nazim, CLP, yes, one of the currencies as well. It's let me just check that out. I'm not sure, guys. It's not on top of my head at the moment. Maybe if you just want to type CLP currency on Google, you'll find that out very quickly. The rest is really easy, right? I can't remember what this is. I think it's got to do with the Polish one or not. No, that's different. We'll come back to that. Let's see where that takes us. CLP. That's a good one actually, Nancy. Let's check it out. If you guys, any one of you guys have actually managed to type that on Google, let me know. Let's see. CLP Chilean. That's the one. Yes, that's the one. Chilean peso. That's the one. Bullish basket, so Chilean peso as well. So you've got the Latin or LATAM, LATAM currencies all correlated. So there may be a reason for that. But they're looking into precious metal itself. Number 3, bullish copper, palladium, gold, overweight metals, and mining equities. Okay, so you see number 4, it says bullish US leverage loans. Again, all the debt kind of what do you call that, derivatives and everything else. These are things that we are expecting as well, and derivatives bubble. Okay, go back to number 1, bullish basket of AUD, NZD. We'll start looking into these currencies as well and correlate that to gold, but we want to focus a lot on precious metals and the 4th part. And then you've got the Chilean peso there, Nazim, thank you very much for that. And then CAD, bullish Japanese equities, okay, and then US auto components. These the reason why I put this here as well, because we've got stock traders too. So stock traders, they are it's also important for them to consider what would be good industries or sectors for them to concentrate on. And here it says auto components, healthcare equipment, supplies, industrial conglomerates, and everything else. European pharmaceuticals, telcos, all this kind of thing. But we want to look into the number 3 area. Let's look into theme number 2 and look at what we could gather from there. Okay, now here, fade markets where inflation is overpriced. Okay, look at the one below here. Bearish US rate, bullish front end rates. Let's ignore that all. Although core inflation has risen from a very low starting point, it isn't much higher globally. So you see a lot of fluff in the news as well nowadays. Mainstream media is sort of guiding all the traders in focusing on something that they want you to focus on. Okay, so they want you to focus on the rate hike. They want you to focus on inflation, but we need to look under the clouds as well. Okay, so this is very important for us to look beyond. Okay, oh, London, how are you doing? You've read here, as you said, today I read that the Indian government is planning to introduce a law to limit a maximum of gold. Very nice. Nice news that is. Very, very important one as well. Limit maximum gold per family, person, and also limit the introduction of gold into the country. You are absolutely right. This is what I'm going to share with you guys as well. I want to talk to you guys about this because highest consumer, there's got this black market, black money area that the government of India is also struggling with, big time, because India is the highest consumer, right? But then now there is something's going to change, really on a large scale. The whole model in India, they're going to go towards silver now, and that's the research I've actually done. I found loads of materials on it, and it's really amazing why mainstream media, Bloomberg, CNN, CNBC, they're not actually putting all this coverage, and this news is fresh from the oven, as fresh as last week or 2 weeks ago about this silver thing, and I'm amazed that it's all there on Bloomberg in very weird timing of the day. They talk about it very little, 1 or 2 interviews only, but these are huge things. And the other thing is about the Sharia of gold. We'll go into that, okay? We'll go into a bit of silver about India and also Sharia of gold as well in a bit. Okay, let's go into this one first. Theme 2. So this is basically about the fluff that is, done by mainstream media, giving you all these ideas. Okay, inflation is overpriced, says UBS. I like to listen to UBS a bit. You know why? Because they've got a large holding of gold. Okay, by top investors. Okay, I hear like Soros or huge hedge funders. They've got it in UBS. So this is something that's important because the reports that come out of certain banks, like not Barclays anymore so much, Citibank still good, but it depends on which part of the report of Citibank, okay? But I still like UBS, ABN AMRO. These two seem to have really sharp trade ideas. So that's the reason why I'm sharing that with you today. Okay, so I like that, and I see that it's a mirror with who are actually investing with them and sort of what they specialize in. And gold holding, that's one of the biggest part. Okay, so what about the third theme that we need to focus on is Europe remains mispriced. What does that actually mean? Now, Euro area assets are the most mispriced among major economies, it says here, although political risk remain. Continuing strength in the German domestic economy. Okay, look at that. Continuing strength in the German domestic economy and pessimistic market pricing for European growth. So in that Eurozone, still German rises apparently on the economy side of things. Okay, European growth and asset markets creates good risk reward. Let's look at the trade ideas below. Number 1. Bullish euro versus a basket of USD, GBP, and JPY. So look at this. This is a nice idea. We are not saying that, okay, this is what UBS says, we go to a chart and then straight away we buy the euro. No, we are looking at possibilities here. UBS is hinting bullish euro versus the basket of USD, GBP, and JPY. So what does that actually mean? That means that we're looking into the potential, from all the previous slides, we're looking into potential fall of the dollar, potential rise of the gold. Here on the other side of it, it's talking about bullish euro against USD. So again, the hinting, it's on the same thing. Okay, downward sort of hint to the US dollar, the bearish type market, and then bullish on the others against the USD. So that does include gold, silver. Okay. Number two, bearish euro USD here. So you see, that's a different thing. Here, bullish euro versus basket of USD, GBP, and JPY, a basket of that. But here, euro USD specifically, that's still on the bearish ground. Okay, that's CZK. You need to look that up again. Bullish euro stocks, that's the group of euro stocks. European autos, okay, favor European HY high yield credit over European IT credit. Okay, so not much there, but here theme 4 is a bit more interesting. A less helpful global context for EM. EM stands for emerging markets in 2017. So I like that red line there. Limited room for commodity prices to fall. Not limited room for commodity prices to rise. Look at what it's hinting us. Again, commodity on the upside. Okay, so with lower current account deficits, higher rates, limited room for commodity prices to fall. So emerging market is less likely to suffer, it says here. That's a good hint. But given the emerging markets are lingering growth issues, our strategists are cautious. Our strategists mean UBSs, okay, UBS. So seeing a year of muddle through with EM deeper in the throes of leverage, and it was a year ago. Okay, let's just forget that. In this slide, UBS expects 2017 to present a more challenging environment for emerging market assets. Okay, prefer emerging market debt to EM equities. This is expressed through long positions in local rates where they see disinflation. That's the euro side of it. Okay. Now in FX we see emerging market weakness in 2017, particularly in Asia. So we want to carry that through. Look at that for you guys in Malaysia. Bearish ringgit and Thai baht. Okay, BHET. So bullish Brazilian currency and the Russian ruble. Okay, so bullish on the Brazilian, bullish on the Russian, bearish on the ringgit, Malaysian ringgit, and bearish on the Thai baht. Okay, so these are the key market implications. So hope you guys grab that a bit, have that in mind, because we are going to go on to part 4 later on, and we're going to go into the geometric side of it, the technical, straight into the technical, see whether that could actually match up with what we are looking at today, or have looked at today. Okay, so here, a bit on the USD JPY, because we would need to still go onto the dollar, look into the dollar index, look into the dollar's position, then we get an idea of what's going on in the States, then we got that idea that it would be correlated negatively to gold. Okay, so here, very boldly, Nomura says that it should rise to 120. We're talking about USD JPY forecast, okay, by the end of 2017. So what does that actually mean? It's got a boom time to the upside USD JPY. For that long, we don't know, but of course it doesn't go in a straight line up. It's got corrections, but this is what it expects. This is far, far reach, okay? But uncertainty in 2008 owing to Trump administration. Look, it still is giving you hints. So it's not really telling you that all this inflation, all this good news about dollar going up is really good news in the States, okay? It's all the hints telling you that this is what's going on, but then it's what's going on to bubble up things that can actually happen for the future, all right? Just part of the process. So here, this is something I got from Stratford, okay, December 7th. Now, dollar strength is a weakness, it says. I have found many others that goes hand in hand with this one here. So the value of the US dollar, it says here, is higher than it has been since 2000. Okay, it appears set to keep rising. The strengthening of the world's reserve currency, USD, the world's reserve currency, will have global repercussions. So again, it's hinting. Don't think it is all good upside, then it's all good and rosy and nice. Okay, it's actually building up something really dark and really on the other side, on the other horizon. So emerging markets, they have borrowed, this is what I'm trying to tell you guys earlier on, emerging markets, they have borrowed heavily in dollars, will bear the brunt of the impacts as they find it harder to repay or roll over their debt. So when they've borrowed, at the time they've borrowed, that time it was a plunge in the US dollar rate, but now US dollar has actually gone up. So that price rise upwards is putting a big pressure for them to actually repay their debts or their loans, okay, for the countries, especially the emerging markets. Okay, so okay, here, this is what I've talked about earlier on, identifying the countries most at risk from a strengthening dollar. Okay, so again, it's like the dominoes effect. Doesn't mean dollars up, it's up for all. It's actually really planning the fall for a lot of other countries. So here, high levels of US dollar denominated debts make a country vulnerable, very vulnerable. Okay, so it is through this vulnerability is reduced if it is covered by foreign exchange reserves, but not many countries are having that. They're having a large amount or share of the dollar. Okay, so a current account deficit also implies vulnerability as it shows money leaving the country. So here, look at this one here, guys. This is very important for you guys from Malaysia, Indonesia, from all over the world, maybe Turkey, South Africa especially. Look at which category they're actually falling. With the strengthening of the dollar, which country is most at risk? That's the one under the blue on the left side. Okay, Brazil, Chile, Egypt, Indonesia. Okay, South Africa, Nigeria, Turkey, Venezuela, and then look into the red ones on this side under Brazil, Chile, and all the countries. The one highlighted in red are the particular points of vulnerability. Okay, that's the one in red. Okay, that is it's quite a big risk there. Okay, also at risk you've got Greece, of course, Vietnam, Malaysia. Okay, and all that. So you see, it's causing a lot of ripple effect with the strengthening dollar. It's going to cause these countries, especially the one on the left, to really suffer big time. Okay, here questions from Nazim. The USD, says Nazim, is the only currency in the world which can't be weakened or manipulated. So what does it mean for the rest of the world, and specifically to the USD remaining the world's reserve currency? Okay, that's a very good question, Nazim. But the thing is that now a lot of experts around the world globally, they're actually questioning whether or not the other people, other countries are really wanting the USD to actually be that reserve currency. You see, they are now questioning to not want the dollar to be that reserve currency. We've got lots of countries who are actually pledging, putting their dissatisfaction forward. And the risk is when these countries who don't want the dollar to be the reserve currency anymore, when they form alliances with other countries that can actually threaten the USD position, the US position. You see, so it's not what they want anymore. Actually, globally, to have that world currency in US dollar. You've got countries like in Indonesia or other countries are actually having even different things as their reserve currency, like diamonds, for example. Black pearl, for example. They're building up on that, but of course that's to a very small extent, but they prefer gold because we've got Jordan, Malaysia, even Korea. They have all been they're evident saying that they've actually been accumulating even more gold for the past 1-2 years, and that's basically going in there. So we need to understand that now we are in a cycle that the international monetary policy could change. So what does that mean? That means that this is actually the time that there may be a possibility for that to change, where people are, the USD is the reserve currency, but we've got a lot of demand for it not to be. You see, that's where the problem is. Here you're saying as well is the only currency in the world which can't be weakened or manipulated, which you've got a point there. The only reason why, it's not that it could not weaken. It could do a lot of things for its currency. It could actually manipulate it in any way, but the way the US monetary policy and the economy works is that it's anti-deflation and it's pro-inflation. So it will do whatever it can to create inflation. It will do whatever it can to not create or cause deflation. That's why you see it like that. Okay, so this is where there's a big sort of debate whether or not currency like the dollar is actually money or it's just currency. In my opinion, it's only currency. It's not, it's fiat currency. It's not money. The one that is money that will always go up in its value, it's gold, silver. Okay, and it's the only one that can actually be backing up the currency, because at the moment USD is everywhere. Okay, you've got 65% of trade, you've got you know, oil, and everything has already been set up a long time ago for all the countries to rely on the dollar. So hence the reason, because of the reliability, that is what you see as dollar strength, but it's actually not dollar strength, because you've got two differences between dollar and the real value of the dollar. All right, let's say you say yuan, for example. Yuan may be falling against the dollar, but the real value of yuan is actually much higher than the dollar. Why? Because it's backed up by a lot of gold, it's backed up by a lot of other things. The problem with the US dollar is that a lot of other countries are sending back the US dollar. Okay, they are sending back, they are selling, like China is selling the US treasuries. So they used to buy the US treasuries from the US. When they are going through inflation, they cannot have inflation in China too much. If they do, what happens is that they send back that US treasury, they sell it back. So what happens is that you get all the cash, the dollar goes back to US, and this is where your inflation happens in the US. So it's, in my opinion, it's not really about strength of the US dollar. It's about the reliability, you know, the ripple effect. The US is in the middle of its own agreement. Okay, it has created all the agreements for all the other countries to rely on it. So not, as you can see just now, I've shared with you all the slides, doesn't mean that the USD strength of its dollar is not going to cause problems for all the other countries, because US is also reliant on the other countries like Asia, especially, and the other countries. So whatever it's causing, it's going to cause it to come back like a boomerang and attack the dollar and the US economy again, you see. So that's basically it. It's my opinion, of course, but this is how it has actually been working for years. You know, it's been mirroring a lot with how the economy has actually performed so far. Okay, all right. I'll go to the next slide, Nazim, if that's okay. Yeah. Let's just move on there. Let's see. Okay. Hope you guys got a picture of this here. Most at risk and also at risk. Hold on. Okay. All right, here, I want to talk a little bit about this one here, because this may be a huge game changer, meaning that this particular news about the new rules for gold investing may open the market to 1.6 billion Muslims, talking about the Sharia gold. Okay, so now keeping gold for value, physical gold, is permitted. Okay, or will be permitted, and that will be announced by the end of the year, if I'm not mistaken. But this will open up a huge gate to people, especially the respective Muslim community, to actually own gold. Okay, and this will rise up. For me, it's a big game changer. I think this will then confirm as well the rise of gold prices, and this is actually a huge thing. Countries like Turkey, Malaysia, especially Indonesia, these are Muslim countries as well, and they are already very big on, especially Malaysia. It's you know, the Islamic banking side of it, it's already quite huge. So imagine if it's, they've got account that could actually be backed up by physical gold as well, and be able to buy physical gold and have that stored in the Islamic banks. This would actually be creating a huge influx of demand for gold. Okay, so this is one thing. If you guys can, type in Sharia and gold, read a little bit about it, and most importantly, look into when this whole thing will kick off. As far as I know, it will be kicking off by the end of the year. So you imagine all this rush before the new year, and then all these things may just bring about a great buying opportunity for gold. Okay, all right. Okay, here we've got this book writer who have actually, this guy's an ex-CIA agent as well. He's been in the commercial crime unit. They have actually, created softwares and special things to simulate what would happen in a financial crisis and everything else. So he is saying that he's looking into gold prices hitting the 10,000 per ounce. But we don't get too excited and start buying gold now. I want you guys to accumulate data and dissect data, and then we confirm it with technicals and with trading stages. That probably be the least, not least, but then do lower your risk and increase your profitability. Okay, you don't want to get too excited with big numbers and simply go in and start trading. But this is what we could see with more and more news coming up about expecting huge influx of gold prices to the upside. And when we look into all these slides that I've shared with you and all these happenings, it looks like it's getting closer to that time. Okay, so this is what we want to look into. How far could we expect that time from now till then? That's what we're going to cover in part 4, and how you trade in the stages. And we use the chart patterns and all that technical analysis side of things to make it a tool of measurement. Okay, how much do we expect the movement, whether we see the patterns, and then we combine that with fundamentals. So here, someone asked about India and India's limit to possessing gold and all that. That's very true. But now we've got a new source of news about silver skyrocketing because it may become India's new metal of choice, as it says. So you can read about it more. The funny thing is that it's not been so much in mainstream media, and being in this area for many years, I have seen that it's a very usual play that certain big news that could actually be big news for practical traders, which usually doesn't actually show in the mainstream media until about 2 weeks, 3 weeks down the road. So this is where it's a new crack of this news here. So Indian government cracks down on large denominated bills. Okay, so this is to, as they say, prevent the black money circulation and all that kind of thing, and reportedly considering measures to limit gold holdings, as you have rightly mentioned there. Now the thing is, it's time for silver. So we are looking at potential silver price to rise as well as gold. So you see, you've got the hints of the USD, mirroring the crash and all that in certain years. You've got the same thing about gold prices, and then you've got the Sharia gold, and now you've got the silver. So these are all giving us, a rise in the looking for opportunities in these precious metals. Okay, all right, there you go. That's just a little bit there, but it's a very interesting read. You guys should look into it more, the correlation between India's current model with precious metal, especially gold and silver. Okay, all right, I see lots of opportunities there. So here, a bit of a forecast by Eddie and Andrew, and it's not long ago. I think it's still stands as it is, their forecast until the end of 2017, if I'm not mistaken. So they're looking into the gold at the, you've got the lower scenario and the higher scenario, 1188 and 1125. So that's a range between 1188 and 1125. That's a price they're looking at until the first quarter of 2018. 2017. Okay, that's just a sort of like a minimum thing. So that's the room that we're looking at. This is what I want to look into in part 4, to look at that, measuring what you see technically using patterns, so we get a bit of an idea, entry areas, probable entry areas, by measuring your risk properly and looking at the potential opportunity to grab as well. So silver there, as you can see, 15.4 up to 16.3. Then you've got 931x63 for platinum. As you can see, you've got palladium, aluminum, copper. These are all prices here. Has not touched these areas yet, but this is basically what we're expecting there. Okay, but at this moment of time, we've got experts today talking about a little bit more room of 1140 for gold, lower to 1140 at least, before it sees room upwards. So this is something I've shared with you guys, I think, in part 1 itself, talking about the differences between the Z-like pattern, the M-like pattern, as well as the sharp pattern that we talked about. So this is giving us a bit more room in expecting gold prices to fall a little bit more before giving it a rise. So this is coinciding with most of the things that we see in the slides today. Okay, let's see. This one here again with ABN AMRO, and we could see there, you could look into this area here from December 16, 2016, December to March, this area here. As you can see, they're expecting the 1350 area to 1300. So 1300, 1280 to 1300 is sort of the average of most banks' prediction for December right up to March. Okay, that's on average. This one here is a bit on the high side, but this is what we talk about trading in stages. Okay, of course you've seen all the news talking about 10,000, 5,000, and all that kind of thing, but we want to work with stages in terms of quarters as well, so that we can break that up technically, and that's important, so that we can lower our risk and increase our probability. So you can see for the rest of the metals as well, you can see average, you can see end period. Okay. All average. I think the first two at the top, that's basically the areas that you could look into it. Okay, mean and average. And you can look into the price average there, gold, first line itself, December to March 17, December to March 17, 132, 503, not too much. So that 1 to 100 to 1300, that's sort of the safe range to expect. Do we see that technically or not? This is what we want to look into in part 4. Okay. All right. The same goes. These are the range of precious metals here, from gold right down to silver, including rhodium, palladium, platinum. They're all color coded here from 2013 right down to the expectation in 2017. Okay, so that's priced there. As you can see, 1,250 at least there for the gold. As you can see, 2017. Yeah, you can see almost 1,2 something here. The blue bar. Okay, end of that 2016, sorry, you can see it ending at almost the same, lower than the rise there, and the rest goes for the precious metal. Okay, just a bit of an idea there. All right. Okay, I think that's basically it for now. I think I've shared quite a bit, but perhaps if you guys have got something to share, or most importantly, if you guys have got any questions, feel free to ask in this part 3 of this notification course. Hope you guys found it interesting. Okay, Colin has got a question right here. Looking forward to the next session. That's an okay, brilliant. Thank you for that, Colin. Thank you for your support. Yes, please email. Yes, please email. Brilliant. Bye for now as well. Have a good evening, Colin. Okay, guys, any more questions from you guys? Any more? Kindly send it, as I've mentioned, to kenny@orbex.com and CC it to Kira, K-I-R-A, @orbex.com. Okay, just to make sure that we get that email and we will respond to you, of course. All right, no questions at all. If at all you guys have got no questions, Sashi, thank you very much too. Most welcome. And if you guys have got no question at all, if you guys have got questions later on, just before you guys go to sleep, or when you guys are dreaming the questions, you can always send me the questions later on via email. Okay, as I've mentioned, kenny@orbex.com and cc to kira@orbex.com. Brilliant. So that's it, guys. I appreciate your time. It's getting late for most of you, I would say, and it's about 10:20 here, Cyprus Limassol time. So okay, guys. So I would like to say a big thank you to you guys for attending part 3 of today's certification course. We'll see you in part 4. That's on the 15th of December. Okay, and we'll see you then, and we'll get cracking into the technicalities, geometric patterns, and we'll start what do you call that? Juicing out the charts with trade ideas. Okay. Okay, guys. Thank you very much. Thank you, Nikki. Appreciate that very much, and we'll see you guys again in part 4. Have a good night, good evening, you guys, and again, once again, thank you very much. Bye bye for now.